Good afternoon. My name is Glenford Robinson, and thanks for tuning in to the Mstardom Finance Weekly Economic Review, where we talk about what's going on in the U.S. economy. And before I go any further, I would like to tell you about this disclaimer, and it goes as follows. I, Glenford Robinson, is doing this broadcast about finance. However, I am not a licensed investment advisor. So whatever I say in this video, whatever I mention in this video, should not be used as investment advice. All right? Because even though I'm studying to be an investment advisor, I am not an investment advisor as yet. All right, so don't use what I say in this video as investment advice. Don't go out and buy some shares or buy the euro or the USD based on what I'm saying. I'm advising anyone who would like to go out and invest to consult with a professional financial advisor or a professional investment advisor before you make any investment decisions. All right. Okay, so for this week I will be speaking about the interaction, what's going on with the European economy and how it could possibly affect the U.S. economy. So I created a title stating that, actually the title goes as follows: Federal Reserve struggling to prevent U.S. economy from slumping like European economy. And again, this talk is from my weekly article that I write. So a couple weeks back I thought about, why not just talking about what I write about in the article and then record myself talking about it. So that's why I'm doing this. I really enjoyed talking about finance and researching about the economy and what's happening. It's just my passion, you know. So I like to talk, and so this is the reason why I'm doing this. Okay, and who knows, if someone find the information helpful, hey, give it a thumbs up, give it a like, subscribe, and hit that bell. All right, and you could visit my website if you would like to see the actual article that I'm doing this video from, and my website is mstardom.com. That's mstardom.com. Okay, so let's delve into things. All right, again, the article that I'm going over, the title is Federal Reserve Struggling to Prevent U.S. Economy from Slumping Like European Economy by Glenford S. Robinson. That's me. That's my name, Glenford S. Robinson. Okay, the United States Federal Reserve recently took steps to jumpstart the U.S. economy by cutting interest rates for the second time in the space of 3 months. The Fed cut interest rates this past week because the agency did not want the U.S. economy to follow the current slow economic growth path as economies in the Eurozone. The big three Eurozone economies, Germany, Britain, and France, will be the countries of interest in our discussion today, because these three countries play the largest role in the European economy. So that's why I'll talk about these three countries. There are a total, I believe, of about 27 countries that makes up the European Union. Okay, first, and when you go to mstardom.com, you will see the economic calendar and little snippets of the date and time of the release. For example, I'm talking about the Manufacturing Pmi, the French Manufacturing Pmi right now, and the previous count, or the previous reading was 51.1, and the forecast was 51.2, and the actual reading came in at 50.3. That means it did worse than expected. People were expecting it to the PMI, the manufacturing PMI, to come in at 51.2, but it came in at 50.3, much less than the forecasted amount, forecasted number, and the previous number, which was, the previous number was 51.1, and the forecasted number was 51.2. All right, so this is what I have to say. The French Manufacturing Purchasing Managers Index, which is the PMI, measures activity levels of purchasing managers in the country's manufacturing sector. A PMI reading above 50 indicates a period of expansion in the sector, while a reading below 50 indicates a period of contraction in the sector. Traders and investors watch the PMI survey because purchasing managers will be the first to know how well their economies are doing from having knowledge of their company's performance data. Therefore, the PMI data provides leading economic indicator information for performance of the overall economy. And this economy that we're talking about now is the French economy. As a result of this very essential information, traders and investors alike put an extraordinary amount of importance in PMI data reports, such as pinning dates and times of PMI economic data releases on their calendars. A reading that is higher than expected should be taken as a positive or bullish for the euro, while that's the European currency, if anyone didn't know. A reading that is higher than expected should be taken as a positive or bullish for the euro, and for that matter, the European economy. While a reading that is lower than expected should be taken as negative or bearish for the euro and the Eurozone economy. So here we see, and you will see when you go check out the article, that the actual number came in at 50.3. However, the previous was 51.1, and the forecasted number was 51.2. So clearly there we're seeing that the French manufacturing PMI came in below expectation. So that tells us there that the economy for that period that was measured is not doing very well. Okay. So let's continue what with the article. I say here, please don't have to, people don't have to be traders or investors to find such information beneficial, because if an American frequently goes on vacation to Europe, then it would be in that person's best interest to want to know the exchange rate of the euro against the USD or the US dollar. And what such rate could be when vacation time comes around in the future. As we can see, the PMI data discussed above paint a grim picture of the current and future outlook of the Eurozone economy, which is one of the big three, which is France. PMI data shows a decrease from a previous reading of 51.1 a month ago to a current reading of 50.3. French economic activities has slowed down to a crawl because consumers are not buying manufactured products. So French companies are forced to cut back on the amount of product they produce. thereby causing the consequent layoffs of employees as a result of not generating enough revenue to pay these employees. So if companies aren't producing products, then business is not doing very well. And if a company isn't able to produce products and is not able to manufacture products, how can the company makes money to pay its employees? So that's a very bad situation, economically speaking, for any economy. You know. So right now we're speaking about the French economy. So here, this is what I say in the article. I say this situation is an economically destructive force that has continued to plague Eurozone economies for quite some time now. This also explains why the current Eurozone interest rate is 0%, causing a frantic and desperate attempt by the European Central Bank, ECB, to implement monetary policies, which includes government security buybacks and other monetary policy tools in the hope that the Eurozone economy will turn around. The current uncertainty caused by Brexit and the current US-China tariff scuffle shed a very dim light on the outlook of the Eurozone in economic terms. All right, so we just spoke about what's going on with the French economy. And as I mentioned before, the French economy, France is a part of the big three Eurozone economies. That means, you know, they have a significant contribution. They contribute a lot to the overall Eurozone economy. So now let's talk about the economy, the Eurozone economy that plays the largest part. And this country is Germany. I mentioned it before when I did the intro, but so just in case you're just joining the show, I'll repeat. All right. So Germany plays the largest role in the Eurozone economy, and Britain plays the second largest role, and the French plays the third largest role. All right, so now let's delve into what I have to say about Germany and Germany's economy. And again, the economic calendar can be seen in the article. Right now, you really can't see it because I'm just talking about it. So, but if you want to see it, just go to Mstardom.com, and you'll be able to see the actual economic calendar and the data and everything. So, what the economic calendar is saying in regards to the German Manufacturing Pmi for September is that, and it was released this past Monday, September 23rd, 2019 at 3:30 a.m. Eastern Time. That's Eastern Standard Time. All right, so what happened? The German Manufacturing Pmi for September. Okay, the previous reading was 43.5. That's way below that 50 point range that tells us whether or not an economy is doing well in regards to the PMI. And the previous was 43.5. So we know that right there, that's giving us a signal. That's telling us that, hey, even previously the German economy didn't do all that well. So let's see what happens. And first, let's go over the forecast. What economists predicted the number was going to come in at. All right. So the economists forecasted that the German PMI, manufacturing PMI, was going to come in at 44.0. 44. However, the actual reading, what do you think the actual reading is going to be? Is it going to be better than forecasted, the forecasted number, or worse? Well, to your surprise, it's not surprising to me because I know things are not doing very well in the Eurozone. The actual number came out to be 41.4. All right, so the German Manufacturing Pmi for September came in at 41.4. All right, so let's see how I put this together in the article. All right, the German Manufacturing Pmi, like the French, contracted dramatically from a whopping 43.5 in August to an anemic current reading of 41.4 in September. In fact, we all learned that any PMI reading of less than 50 presents a real problem for any economy suffering from such decline in manufacturing activities. So from bad to worse, shall we say, for the German Manufacturing PMI and thus the German economy. Yes, indeed, things look very bad. Economically for Germany, who actually plays the largest role in the Eurozone economy. So, this is what I say in the article. I continued by saying, therefore, overall, the economic outlook in the Eurozone presents a very bleak picture. And with Britain fighting to leave the Eurozone or the European Union in Brexit, that's what Brexit means. Britain trying to exit the Eurozone economy. Things look doubly worse. Britain, being one of the big three, Germany, Britain, and France, plays the second largest economic role in the Eurozone, behind Germany, who plays the largest role. And with the advent of the British leaving the European Union, an economic collapse of epic proportion seems undoubtedly inevitable. So that's what I said said in the article about that, and what's happening with the German economy, and the German economy being the largest contributor to the Eurozone economy. So we went over the French economy and spoke and noticed and mentioned that and realized that and saw that the French economy isn't doing all that well. And now we also see that the German economy is also not doing well. All right. All right, now we're going to talk about, I won't really talk much about the British economy, because the British economy is not doing as poorly as the other big three members, French, Germany, French and Germany. And the fact that the bad thing that's happening with Britain is that, you know, it's leaving the economy. It's leaving the Eurozone economy through Brexit. So that's why I'm not even going to go into that. So I try to focus on the economies that's really doing terribly. Well, the British economy is not doing like extremely well either, but for the most part, it's a little bit better than the others. It's doing a little bit better. And if I say something in this video that's not completely correct, hey, correct me, man. I'm not perfect. You know, just put a comment and say, hey, Glenford, man, you know, the British economy is, you know, walloping all the other economies, man. What do you think? What do you mean by it's not doing all that great? Yeah, man. So, you know, disagree with me if you can, you know what I mean? Because I'm just going to get better, you know? And as I said before, I enjoy doing this and I enjoy talking about the economy. So, and in life, when you're passionate about something, it's best to do what you're passionate about. All right. So that's how I look at things. All right. Now, so let's talk about the U.S. economy and how the U.S. did in regards to its manufacturing PMI for September. we went over the French economy and the German economy and see that they weren't doing all that well. So let's see how the U.S. is doing. All right. All right, and again, the economic calendar can be seen on Mstardom.com, because what I did, I put a little like a table that's telling you the date of the release, that's showing you the date of the release, and in this case, it was Monday, September 23rd, 2019, at 9:45 a.m. Eastern Time. This is for the U.S. dollar, the USD, or the U.S. economy. So this is the U.S. Manufacturing Pmi for September, and so now, well, I'm gonna give you a little sneak peek. The previous reading for the U.S. Manufacturing Pmi for, was 50.3. The previous reading was 50.3, and I'm gonna tell you about what economists forecasted. They forecasted that the actual number was going to be 50.3. So let's see. What do you think? Do you think that the U.S. economy beat forecast? Guess. Did it or did it not? All right. So let me fill you in. The U.S. economy is doing much better than the Eurozone economies. And the manufacturing PMI for September, the US manufacturing PMI for September, confirmed that. So the actual release, the actual number is 51.0. So the previous was 50.3. The previous manufacturing PMI for the for the US. I keep saying USD because I'm a trader. I trade the euro and the USD. So I can get the USD. So the previous was 50.3. The previous manufacturing PMI for the US economy was 50.3, and the forecast was 50.3, and the actual came in at 51.0. So the U.S. economy beat forecast. This is what it means when economists saw those guys on TV, those finance guys say, "Oh, the economy beat forecast," and whatever indicator they're talking about. In this case, we're talking about the PMI indicator. So the U.S. Economy beat forecast by its manufacturing PMI for September coming in at 51.0. So let's see what I said about it in the article. All right, I said the U.S. economy, on the other hand, although not doing all that well either, presents a brighter outlook than the Eurozone economy. The U.S. manufacturing PMI data reported on Monday, September 23rd, 2019, at 9:45 a.m. Eastern Time, came in at 51.0. beating forecast of 50.3, and the previous reading of 50.3 also. The results confirm that manufacturing activities in the U.S. increased from last month by 0.7. But such meager reading should not be perceived as an overly outstanding mark, because an increase of just 0.7 still shows weakness in the economy. And such weak economic growth could, coupled with the slowed economic growth in Europe, Brexit, and the US-China trade war, things could spiral out of control very quickly if we're not careful. And when I say we, I mean we per se, the regular consumers can't do much, but the Federal Reserve is the governmental agency that can help the economy, help jumpstart the economy. This past week, the Federal Reserve unleashed one of its monetary policy tools by cutting interest rates from 2.25% to 2%. Now we can see why the Fed cut interest rates. The Fed decision was questioned by many in the media, but as we can see from the PMI readings above, the interest rate cut this past week on Wednesday, September 18, was justified. The CPI inflation rate numbers rose from 1.6% to 1.8%, soon after the Federal Reserve cut interest rate for the first time in over a decade, a couple of weeks ago. So if the inflation rate remains at 1.8%, even after this recent rate cut, for an extended period of time without increasing closer to 2%, then the Fed will cut interest rate again by another 25 basis points. In fact, the Fed will continue to cut interest rate until the inflation rate gets to 2%. If it takes 2 more interest rate cuts for the inflation rate to get to 2%, then the Fed will cut interest rates 2 more times. If it takes 3 more interest rate cuts for the inflation rate to get to 2%, guess what? The Fed will cut interest rate 3 more times. So we see here, whatever it takes for the Fed to increase the inflation rate to its target mark of 2%, the Federal Reserve will do it. The way things look economically, taking everything that we have spoken about so far into account, we can safely predict with a certain degree of accuracy that the Federal Reserve will cut interest rates again. So that's my prediction. And that's a lot of other people's prediction also. When I say people, you know, those economic guys, those guys on TV, financial analysts and all those guys. That's what they're saying. All right, so now that we finished speaking about the PMI, let's see which other indicator is gonna show us that the US economy, while doing much better than the Eurozone economies, is also not doing all that great. I said that because why would the Federal Reserve cut interest rate twice in the past 3 months actually, if our economy was doing all so well? If it was doing all that well, then why would the Fed have to cut interest rate? So by the Fed cutting interest rate, that's telling us that our economy is not doing all that great. Even though it's doing much better than the Eurozone economies, it's still not doing all that well. So we're going to review and we're going to go over another economic indicator that help us see what the economy, and how strong the U.S. economy is. All right, and this one is called the new home sales. The new home sales report. That's another very important economic indicator that economists and traders and investors and fund managers and hedge fund managers look at in order to manage their portfolios and so forth. All right, so the economic calendar of new home sales for August. This was released September 25th, 2019 at 10 a.m. Eastern Time. And again, it's called the New Home Sales Report, and it's a very, very important indicator to telling you, which shows you what's happening in the economy. And it's the new home sales for August, like a month ago. All right, so the previous mark, the previous was very good. It was 666,000 new homes, new home sales. The previous month, and the forecast was 660,000 homes, new home sales. All right. So let's see. What do you think the actual number is gonna be? All right. And this was released again on September 25th. All right. Can you guess? Try to guess. And if you guess correctly, put it in the comment below. All right. Well, indeed, the actual number came in above forecast and above the previous reading. And that actual reading is 713,000 new home sales. All right, actually, yeah, 713,000 new homes sold in August. And that's an improvement from 666,000 homes sold previously. And it smashed forecast of 660,000. All right, so this is what I said in the article. New home sales for August unexpectedly beat forecast, posting a whopping count of 713,000 new homes sold, demolishing forecast of 660,000 and beating out previous readings of 666,000 new homes sold. No one expected this because the previous reading wasn't very strong, and the economy hasn't been the strongest lately either, which has caused the Federal Reserve to unleash economic stimulus tactics such as cutting interest rates in order to gin up the economy. Yes, gin up the economy. That's G-I-N, gin up the economy. Get used to that word, gin up the economy, because that word gin and the phrase, because I may be using it in the future. The new home sales report shows the number of new single-family homes sold during the previous month. New home sales data released ahead of existing home sales data tend to have more significant and therefore more impact because the reports tightly correlate with each other. A higher than expected reading presents a positive outlook for the U.S. economy and therefore the U.S. dollar, while a lower than expected reading presents a negative or bleak outlook for the U.S. economy and the U.S. dollar. A 47,000 new home sales increase is better than nothing, but still isn't all that impressive. Wow. So even though the U.S. economy and the new home sales report came in positively, it still wasn't all that strong. It wasn't all that strong because it should have been stronger. But still, it's not that bad. But and it's much better than the Eurozone economy and signals that we get from the Eurozone economy. And then again, the Federal Reserve continues to cut rates, right? So you can't disagree with me for saying that the new home sales report, even though it beat forecast, is all that great. You can't disagree with me for saying that even though it beat forecast, it's not all that great. It's not all that impressive. The number is not all that impressive. You know, you can't disagree with me too much because why would the Feds be cutting interest rate if the U.S. economy was all that great and it was doing all that great? You know? So you can't disagree with me too much on that. Put your comment down below and let's talk about it. Let me go back to the article that I wrote. I'm just continuing. A positive new home sales report tells us that U.S. consumers feel good about the economy, though they are willing to assume new mortgages. All right? The positive new home sales report also tells us that banks are willing to give consumers loans in the form of mortgages to pay for these newly built homes. A lower interest rate makes it possible for banks to lend more and makes it easier for consumers to get loans from banks. This positive relationship between low interest rates, banks, and consumers increase the flow of money into the U.S. economy, thus increasing economic activity. With the purchase of new homes, the sale of durable goods will also increase because new home owners need to buy durable items such as refrigerators, washing machines, furniture, stoves, and any other long-lasting items for their new homes. So we would expect that the core durable goods order for August, to increase. And we would expect that it would, the new core durable goods order for August, we expect it to increase, right? Of course, because that is just common sense. If you get a new house, you just buy a new home, you just buy a new house, aren't you gonna buy a fridge, a stove, microwave and all those things? Well, of course, that's just common sense. And I don't have to be an expert, and you don't have to be a rocket scientist to see that it makes sense. If you get a new home, you buy a new home, you're going to buy these appliances to put in your new home. All right, so let's see what happens with this other economic indicator that we call core durable goods orders. And this happened to be for August. All right, for the previous month. Again, this I'm looking at the economic calendar, and I have a little snippet of the economic calendar, and you will see it on Mstardom.com when you go check out the article for yourself. And in September 27, 2019, at 8 a.m., this when this release came out for the U.S. economy. And again, this economic indicator is called core durable goods orders, month over month for August. All right, so the previous, all right, I'm not going to quiz you, and I'm not going to expect you to know what the previous was. I'm going to tell you what it was. But I'm going to expect you to tell me. Yeah, I expect you to tell me, and I expect you to know, of course, if it beat forecast or not. Let's have a little fun with this. All right, so I'm going to let you know that the previous core durable goods order was less than 0.5%. Yep, less than a negative. It was negative. It was negative 0.5%, not less than, but negative 0.5%. And the forecast was 0.2%. So what do you think the actual number came in at? It came in at, huh? You want to guess? You shouldn't guess, because I've been telling you what was happening with the U.S. economy and how the U.S. economy is going, and it's functioning, and it's it's doing its thing. Not all that great, but much better than the Eurozone economies. All right, so let me give you the number. The actual number is 0.5%. The core durable goods order for August came in at 0.5%. So let's see what I said about this in the article. Well, yeah. Well, the previous paragraph I said, and I predicted, and I asked a question, and I was arguing that the core durable goods order for August should increase because new home sales increase. So people are gonna be buying new items, new durable good items like refrigerators and so forth for their new homes. Well, the core durable goods order came in at 0.5%. 0.5%, and it did exactly what I expected. It came in higher than the previous reading. So this is what I have to say here. This is what I said in the article. Well, it did. Well, the core durable order number came in at 0.5%, and it came in higher than expected. The core durable goods order report for August increased as a result of positive new home sales numbers, increasing from previous readings in July of negative 0.5%, to an anemic current reading of 0.5% for August, beating out a measly forecasted 0.2% increase. So even though the number came in higher than forecast, it's still anemic. And I went further to say, core durable goods orders data shows the change in the total value of new orders for long-lasting manufactured goods for the previous month, excluding transportation items. And the higher than expected reading indicates a marked increase in manufacturing activity, which is excellent for the economy and the US dollar. A tiny increase from negative 0.5% to 0.5% is yet again not a very large enough increase for us to feel happy about. All right, so there we go. There we have it. The economy is doing its thing, but it's just not doing all that great. It's chugging along, but it's not doing all that great. But then again, much better than Eurozone economies. All right, so let's look at the other economic indicator. This economic indicator happens to be a very important one, and this one measures the health and the heartbeat of the U.S. economy. And this economic indicator is called the real GDP, or in natural terms, or in average speaking, the GDP. And this happens to be the GDP for the second quarter, and it was released September 26, 2019 at 8 a.m. Eastern Time. All right, and it's the second quarter GDP, and the previous was 2.0%, and the forecast was 2.0%. Do you want to know what the actual reading is and what it came in at? It came in at, did you guess yet? All right, the actual reading came in at 2.0%. So the previous reading was 2.0%. The forecast was 2.0%. And the actual reading is 2.0%. What is that telling you? Huh? And the GDP measures is the most important indicator, and this tells you really what the economy is doing. So if the previous was 2.0%, the forecast is 2.0%, and the actual is 2.0%, what is that telling you? The U.S. economy is pretty much flatlining. It's not improving. It's not. Now you see why the Fed keeps cutting interest rate, because when the Fed cut interest rates, that the process of cutting interest rate regenerates the economy and restart the economy. All right, so this is what I have to say. This is what I said in an article. Gross domestic product, GDP, shows change in the inflation-adjusted value of all goods and services produced by the economy for the period of time measured. The indicator provides the broadest measure of economic activity and is the primary indicator gauging the economy's health. An actual reading greater than forecast present a positive or bullish outlook for the US dollar and the US economy. The GDP report displays measured data on a monthly basis. Let me say that again. The GDP report displays measured data on a monthly basis. The indicator consists of three versions: the advanced release, second release, and final release. Economists tag both the advanced release and the second release as preliminary in the economic calendar. Yeah, so if you look in the economic calendar, this is how they tag it. If we take a look at the current GDP reading, we will see that the current reading of 2.0% hasn't changed from the previous reading of 2.0%. In fact, even the forecasted reading of 2.0% came in on target. Now, what is this telling us? This data is simply telling us that the United States economy has not improved from the previous reading. This should be a cause for concern because the GDP is the barometer that measures the health of the economy. Therefore, if GDP data hasn't changed from previous readings, then the economy has not improved from last month and is pretty much the same as it was from the last reading. Wow. We have yet again come across another confirmed reason why the Federal Reserve is continuing to cut interest rates and will cut interest rates again in the near future, possibly at its next major meeting. May we say the Federal Reserve has no other choice but to unleash all its arsenal of monetary policy tools to prevent the US economy from running aground like the European economy. Yes, yes indeed. The Federal Reserve has no other choice. So there we have it. This is the current state of the US economy. And I'm recording this on September 30th, 2019 at 5:49 p.m. So the way things look right now on September 30th, 2019 at 5:49 p.m., the US economy is not doing all that great. And as I've said before, the Eurozone economy is doing even poorly. So guess what? That economy, the Eurozone economy, the fact that it's doing so poorly can pull down the U.S. economy, because the U.S. economy is not all that strong anyway. And with this trade war and Brexit and Mr. Trump and this and that, China, this, that, trade war, back and forth, anything can happen. Things could really spiral out of control if we're not careful. So we have to commend the Fed for continually trying to steer the ship and to make sure that our economy doesn't run aground. So all those people who are disagreeing with the Fed for cutting interest rate, I don't agree with them. I'm not going to say they don't know what they're talking about, because everybody is entitled to his or her own opinion. But you can't blame the Fed for trying, man. You can't. Because right now, the Fed even mentioned it. We're currently in an expansion phase. Our economy, the U.S. economy, is currently in an expansion phase. And the outlook is favorable. However, even though the outlook is favorable, we have to be very, very careful. And we have to watch it like a hawk. Watch the economy. Watch numbers in the economy. Watch these indicators. Watch the inflation rate. To make sure that, you know, our economy don't run aground or self-destruct. So I have to commend the Federal Reserve and Mr. Powell, Mr. Jerome Powell, the chair of the Federal Reserve, for, you know, doing his best and trying to make sure that the U.S. economy stays afloat and doesn't go down the path as the Eurozone economies. You know? So that's what I have to say for the week. And thank you for tuning in to the Mstardom Finance weekly review, a weekly economic review of the U.S. economy. And even though it's the U.S. economy, you know, I have to talk about other economy that interacts with the U.S. economy because we don't live in a vacuum. All right? So I'm praying. I'm praying for you, for the Eurozone. I'm praying for the Eurozone, you know, to get their act together and to start improving. I'm hoping that it improves, because if they continue to struggle, guess what? That's just going to drag the U.S. economy down too. And we don't want that. All right? And if you like this video, give it a thumbs up. Please subscribe. And please hit that bell. All right? So I can find the resources to continue to give you quality videos. I tell you again, I mention again that I really enjoy what I do. I enjoy this. I'm a clinical laboratory scientist by trade. And again, I had mentioned this in the first video last week, that I trade the Forex market. And I also teach a Forex course, Forex trading course. And again, I shall reiterate that I am not a licensed investment advisor yet. I am studying and all that stuff, but I'm not licensed yet. And again, please don't use what I'm saying here or what this video, information in this video, as professional investment advice, because I am, quote unquote, not a professional in speaking about investments, all right, or the economy. However, I'm passionate about it, and I do my research, thorough research, and I seem to know what I'm talking about. And you know, all the governmental bodies, we just want to protect investors, and you know, so that's why the governmental bodies that govern and regulate investment information and all that stuff, they're very, very strict about people who give investment advice and everything. You know, you have to make sure that you know what you're talking about, because you don't want to mislead investors. All right? So again, don't use this as investment advice, even though if you do your research, you will confirm, you will see that the information is pretty good. All right? And again, I shall leave now, because you know me, I'll talk all day. All right? I'm an introvert and very analytical person. I'm a very analytical person, but I love to talk. All right? So thanks for tuning in. And just don't forget to visit mstardom.com to see the actual article that I've spoken about today. And just post a comment, man. Criticize me, man. Post, because the more you post things that I need to improve on, guess what? That's the better I'm gonna get. All right. I don't have grudges. I'm not gonna be mad that you say, yo, man, you need to do this better. You need to do that better. You need to talk about this better. You know, I need feedback so I could improve, because I really love this. I really love doing this, and I'm just hoping and that people will give me feedback and interact with me in the comment area. Just let me know. Let me know how I'm doing. All right. Again, my name is Glenford Robinson, and I am signing off. Thank you for tuning in and listening to me. All right. You are great. All right. Bye bye.